From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for April 17th, 2026. Let's see what's happening. It's gallery night and day this Friday and Saturday. The Art Museum has art in bloom through Sunday, and the Brewers hit the road to play Miami this weekend, followed by the Detroit Tigers. Miami to Detroit, so apparently the schedule makers are not Brewers fans. Hot off the press is an associate professor from the University of Colorado School of Medicine recently said cannabis can affect your ability to store information in the short term. In other words, short-term memory loss. That's news. Well, where has this guy been for the last 60 years? I'm sure he forgot. More medical news. According to Dr. Oz, the president has argued that diet soda is good for him because he said, if it kills grass, it can kill cancer. I heard that Roundup is making an excellent salad dressing. And finally, Greg Phillips, who leads FEMA's Office of Response and Recovery, claimed to have been transported and teleported multiple times, even once to a Waffle House, 50 miles away. I wonder if he used the fly-through. On the podcast today, we have Dave Sandstrom, John Sandstrom, Joel Driesing, and with a wrap-up of the week, here's Kyle Tedding.
Well, thanks, Max, and what a week it was. The NASDAQ up 6.8% this week. The S&P added 4.5%, up 309 points to record highs on the week. And the Dow Jones Industrial Average added 3.2%, closing at 49,448. For the year, NASDAQ up 5.4, back in the lead. The S&P, though, up 4.4, close behind, and the Dow now up 3.3%, all including dividends. Dave, hard not to be ecstatic about how strong of a week it was for markets. A lot of it early in the week, at least, coming not from the thing on Friday that drove all the good news, this potential news that the Straits open, that ships should start coming through. But early in the week, it was driven more by some optimism over earnings, optimism over the fact that maybe things were moving along as they had been going back 6 weeks before the start of this war.
Yeah, pretty much good news across the board, Kyle. I think you hit a nail on the head. Anytime you can have a week where you have a major breakthrough in a war, certainly opening the Strait of Hormuz is good news. We'll see if it sticks or not, but certainly great news there. But really, when you boil down to what fundamentals are and what we're paying attention to, corporate earnings off to a very good start this week. So maybe to get the headlines that some of the war topics did, but for those of you paying attention, it was a great start to earnings season. So I think the two really compounded each other. And boy, I'll tell you what, 6.8% in growth stocks this week. We'll take it.
Yeah, John, banks and technology stocks reporting earnings in large part so far. Banks in particular stood out to me, pointing to consumer spending that's been more stable than we might have otherwise feared, given all the uncertainty. And then businesses like Taiwan Semiconductor coming out and saying, hey, we're still seeing a lot of that spending in the AI space, a lot of that growth forecast. I think a big part, again, of why maybe the NASDAQ came up as much as it did this week. But then we've seen some other businesses. You and I were talking earlier in the week about Allbirds and this pivot towards AI. We may now be in a universe in which there are businesses that seemingly have nothing to do with technology that have decided that adding those kinds of things to their name might attract investors.
Yeah, and I think the Allbirds example is a funny one, being up 600% in a day when they just randomly decide to say that they're now an AI company instead of a shoe company. We might touch on a reason or two later why we don't decide to make day trades or anything along those lines. But I do think the consumer spending piece is definitely something that is more impactful longer term for the U.S. economy when you're looking at just performance of the markets and positive indicator. Obviously, you get the geopolitical stuff that causes massive sways based off of headlines and can change from day to day. But this kind of data coming out definitely seems more of a positive baseline structure moving forward for the U.S. economy, and banks, obviously kicking off earnings season great so far.
You know, it's interesting as we have looked at now kind of two major news items this week, one in the earnings, one in the straight reopening. The CBOE implied volatility index, the VIX, so often quoted, back now down to levels that we saw prior to the start of the Iran war. So investor expectations, I think, are for things to be a little calmer from here. Of course, I think investors have regularly been caught off guard. And Dave, perhaps a reminder that trying to time those kinds of things, trying to time the headlines, trying to pick the bottom or pick the top for our portfolios is maybe a fool's errand. Instead, picking a balance and allocation that we're comfortable with, sticking to it is probably the more appropriate path.
Absolutely, Kyle. And I think these time frames, when you see what we've experienced here in the last several weeks, they just drive that point home even more and more. It's impossible to know what tomorrow is going to hold in the markets, especially during these volatile geopolitical events. Things can change so quickly, multiple times in a given day, as a matter of fact. So, you're going to disappoint yourself if you're trying to time the market. Stick to the fundamentals and, look at valuations, trends on long-term interest rates, things that matter to the ultimate valuations of stocks and the markets in general.
Well, and John, perhaps it's also a reminder that we had built into portfolios for clients things that were designed to be accessible in those periods of heightened volatility. We had built into portfolios some things that were designed to add some stability. And so how do you talk to clients about, well, here's why we're doing what we're doing, and it's not trying to chase returns or run away from the risk?
Yeah, I mean, it's always a conversation that we have to make sure that your short-term needs are covered by assets that you can get at and are readily available and not exposed to the crazy headlines that you see every day. That's why we have conversations with everybody as much as we do. And just to point back to not being able to predict things, if you go back 3 weeks ago and then you were able to predict that the NASDAQ was going to go on its longest winning streak since 1992, I mean, how would you possibly have been able to see that one coming?
No, I think that's fair. Dave, we've talked at length on the podcast about how the labor market seems to be up and down, how the economy overall seems to be fairly stable. We have not seen this massive amount of job growth, and yet we have seen some economic growth. A good article in the Wall Street Journal kind of pointing to maybe some of the rationale as to why. What do you look at as you're trying to wade through, okay, how can the economy kind of continue on that slow and steady pace, even if the labor market's not always telling the same story?
Yeah, Kyle, just a bit of history on GDP growth in the history of the country. There's only two ways you can grow the economy. It's either by adding workers to the workforce to produce more goods and services, or make your existing workforce more productive. In the course of our history here as a country, we've always grown our population, and about half of our GDP growth has been attributed to the growth in the labor markets, and about half has been attributed to productivity. For the first time in U.S. history recently, we saw the labor force in this country and population decline. We're in a situation for years now, birth rates have been on the decline. We've had a massive migration into retirement from the baby boomers. And of course, we've restricted immigration policy in this country, so we don't have a lot of opportunity for workers coming in. So the labor market shrinking right now. And now, in kind of a strange way, that does provide some stability to the unemployment rate, because while you're laying workers off, think about it. If you were also bringing in all kinds of other people newly looking for jobs, you exacerbate the situation. So the fact that we are not growing that labor force organically, the layoffs haven't been as impactful. Add to that now, we're on the eve of artificial intelligence, and productivity numbers have been on the upswing. And we saw last year productivity increase by 2.1%. The Federal Reserve came out this week and talked about how the break-even point for that labor market is almost zero now. And that means how many jobs you have to create to be able to absorb all those new entrants coming into the market. And so it's rare, and maybe never have we had a situation like this. So all this boils down to is productivity now is going to be king. We don't have the workers coming in. So it really boils down to, you guys, is it's not so much do you want to participate in artificial intelligence? Do you want to embrace artificial? The answer is you have to. And I think that's what the economy is going to have to really clutch onto here if we want to see economic growth continue.
And Dave, it usually takes a while to know that technology is helping productivity. It takes a while for the economists to sort of ferret that out. But we're starting to see that even in a no growth labor market that we're maintaining productivity. Productivity now is much higher than it was in the business cycle that came before this, and it's actually about average to what it's been since World War II. And what that means is, bottom line, is that if you're making more products with fewer workers, and you're growing without growing the number of workers and the number of hours that they're working, then you've got the potential for paying those workers more, and splitting up the same pie with fewer people, and also there's a better potential for profitability of the companies making those things.
And Julia, economists would also tell you that there is a very tight correlation between standard of living and productivity. The more productive we are as an economy, the faster we improve the standard of living in this country.
Well, I think that is such a critical point, and a reminder that productivity gain doesn't come without some capital expenditure on the front side, and we have seen that in the build out of the infrastructure around artificial intelligence, these massive data centers, the amount of energy infrastructure that is necessary and will continue to be necessary for that. That's all real money making its way into our economy near term to long term, allow the money that's being spent to be more productive down the road. And so the question I often get is, why would I want to invest more money in the stock market right now when the S&P is trading at 21 times forward earnings, the 20-year average maybe around 17, the more near-term average a little bit closer to 19.5 or 20? Well, the answer is because when businesses spend that money, well, they used to make $8, $9. Now they're going to make $10 or $11 for every dollar they spend. And it is that much easier for investors to see that growth pass through the bottom line. We should be willing to pay up for that growth. The challenge in saying that is it isn't a straight line up. And so there are some bumps and bruises along the way. We take some false steps. But I think if you are comfortable in the businesses you are investing in, if you're comfortable that story of productivity growth remains intact, and that is largely what we've seen the last couple of weeks of earnings reports, is that all the businesses involved in that technology continue to believe that story remains intact, well, then you absolutely should be willing to pay up for those businesses. That's where the growth is coming from. Joel, the economic story continues to evolve. I think the big one that we continue to keep an eye on is prices, and we had a report from producer prices this week, now starting to account for at least some of the impact of the early days of the war.
Right, the producer price index went up 0.5 percentage point in March, and that was led by energy prices, 8.5%, 1 month increase in energy prices, including a 16% increase in gasoline costs. We're seeing the consequences of the war raise oil prices, and that's raising gas prices and raising energy prices and raising inflation. The International Monetary Fund this week actually came out with a report and their forecast saying that they think that the war in Iran, even if it stopped today, is going to have an impact globally and slow down the economy, raise inflation, and maybe push us closer to having a recession. At the same time, though, think of the last few years. We survived a pandemic, a global pandemic. So far we're surviving the Russian invasion of Ukraine. We had 40-year high inflation numbers just 4 years ago, and now this latest conflict in Iran, and we haven't been in a recession in all those times.
Yeah, I think it is so interesting to look at the impact of this war and how much global trade has to shift as a result. I think we often miss that part of it. We say, well, the strait's open, and so it should be back to normal if it stays open. But the reality is we had 120 million barrels of capacity of tankers, just ships on the water, that historically had been in the Middle East that are now steaming towards the U.S. to pick up oil here. We can't load those ships fast enough to get them back out onto the ocean to deliver that oil where it needs to go. And further, to get to China, it's an extra 20 days to come from the Gulf than it is to come from the part of the world in the Middle East, the Gulf of Mexico, from the Gulf of America, depending on who you want to ask, to China relative to what it would have taken to come from the Gulf of the Middle East. And so there are these meaningful consequences to that reorganization that I think the IMF rightfully points out has a lasting impact even if the war ends today, because now those ships have been contracted for the better part of the next 100 days. That's it. They've already committed to what they're going to do. And so when we look at some of these impacts on prices, yeah, the spike happens quickly, but that decline back to some more normal level may take a little while longer.
So I have a question that's a little bit off topic, but I'm thinking somebody here could answer it. So is there a consequence for oil sitting while it's waiting to be transported? I mean, it's not ice cream. It's not going to spoil, right? But does that add to the costs of then making that a usable product?
Yeah, it has spent a few 100 million years in the ground. So I would venture that sitting in a tanker or a tank somewhere probably an okay place to be. I think back to the pandemic and the amount of oil we had just sitting in ships out on the ocean because we didn't have any place to store it. We have run into a similar problem in certain parts of the world right now. We have lots of excess oil. We just don't have the ships going through in order to transport it. And so I don't think the issue is spoilage as much as it costs more to get oil from our Gulf over to China. And so the end products, the refined products, cost more because there is some consequence to that transport.
And I also remember in the Middle East, they don't have a lot of storage. They've been accustomed to literally pumping oil out of the ground and into boats. And so it's not as if they've been able to just this whole time continue to pump oil and store it so it's going to be readily available for sale. They had to shutter some wells. And that's not it's not like turning a light switch on and off. There's a lot of work involved. And a lot of times if you turn a well off, you don't come back to 100% production ever by turning it back on. So there is going to be further implications to the delay a lot of the Middle Eastern oil companies are going to experience because of this.
And I would venture money to be spent reworking how we distribute oil in the future. Talk of new canals, talk of new pipelines through the Middle East to get oil to other parts of that region. All of those require significant spend. All of those potentially add to future costs, even if it creates some stability in the future over how we get access to those markets. Beyond prices, Joel, we had data on housing this week and existing home sales in particular. It's been a volatile place to look, but not terribly exciting news there.
Sluggish is what the National Association of Realtors has called it. And yeah, we're selling houses right now on a 30-year low, and it's not looking a whole lot better with mortgage rates up a little, especially since February 27th. We also have a real lack of supply. And one of the things that the National Association of Realtors said in their report, which was interesting to see numbers on it, but they figure that we're 300,000 to 500,000 houses behind where we should be in order to have a more sustainable level of supply versus demand. That's 22% to 37% difference. And, as we've said before, you just can't make houses fast enough to close that gap very quickly. The bright side of that, though, is that housing prices keep going up. So if you already have a place, it's getting more valuable. And with the stock market up, then you have the wealth effect of people feeling that they're pretty comfortable with their house and their investment holdings, and so they keep spending money, and that's one of the things that's making the economy resilient now, is that despite people being worried about inflation, they keep spending money.
Yeah, we talk about the wealth effect, and I think a higher stock market certainly helps. Higher home prices certainly helps. The part that hurts is maybe prices overall have gone up, and so you don't quite get the same bang for your buck that you did looking back 6 months, 6 years. But again, to your point, I think it is an interesting note that those that have seen the value of the things they have grow pretty substantially. Maybe one more piece of economic news this week on the manufacturing side. We had a report on industrial production and some more signs that broad measures of the economy are showing some slowing.
Yes, the industrial production numbers from the Federal Reserve showed that industrial production slowed in March by 0.5%, and that would include slower production for mining, for utilities, and for manufacturing. And again, though, if you look at the longer term, for the whole first quarter, production was up 2.4% on an annual basis, and that's decent. That's pretty much average over time. And again, that's all happening despite uncertainty about tariffs, despite uncertainty of the ongoing war that started at the end of February, and uncertainty of what's next, what else is out there that's going to cause uncertainty.
I think uncertainty may be the word, but some certainty that it was a good week for markets overall, back to positive across the board for the broad indexes. And again, for investors, I think a strong reminder that patience does pay off. Choosing your allocation wisely and sticking to it has proven to be the answer over time. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.